The financial markets are currently preparing for a $4 trillion wave of initial public offerings. This incoming pipeline is heavily concentrated in artificial intelligence and aerospace, targeting mega listings for entities like OpenAI, Anthropic, and SpaceX. The lead asset in this group is SpaceX, which is seeking an opening valuation of $1.75 trillion. To contextualize that number, a single company is demanding a market capitalization larger than every American defense contractor combined. Yet, underneath that price tag, SpaceX recorded a $5 billion net loss last year, largely driven by its XAI division, burning over $1 billion in cash every month. Selling $4 trillion of equity at peak valuations requires an immense pool of available cash. However, the retail consumer base is tapped out. The United States personal savings rate recently plummeted to a 4-year low of 2.6%. This creates a mathematical failure point. There simply are not enough voluntary, organic public buyers with the liquid capital necessary to absorb a $4 trillion stock issuance at peak prices. With organic demand exhausted, the logistical success of this IPO pipeline depends on a systemic transformation, one that moves away from a reliance on voluntary buyers. The system is being re-engineered to transition trillions in private sector risk directly onto the balance sheets of passive retirement accounts, pension funds, and 401ks. This marks a shift from merit-based capital allocation toward a regime of automatic absorption. It is a structural evolution that introduces a specific, targeted threat to the safety of standard retirement portfolios. To understand why these valuations require a structural exit, we must look at the underlying math. We are currently seeing an earnings bubble, where the corporate profits used to justify sky-high valuations are being systematically manufactured. This manufacturing process relies on a circular accounting loop. The cycle starts in the bond market. This year alone, major tech companies issued over $150 billion in corporate debt. Big tech borrows cash and pledges it to AI startups, who funnel the money right back to rent computing power. The circuit closes. Big tech books this as revenue to justify high valuations. Yet implied returns are deeply negative. Meta operates at negative 28.8%. The capital required to maintain this hardware infrastructure is vast. Analysts at JP Morgan project that several of these tech entities will face a total collapse in free cash flow margins, hitting zero by 2027. They are spending more than they actually bring in. To keep the valuations intact, the tech sector urgently needs these mega IPOs to validate their paper profits on the open market, and they must do it before the internal debt loop runs dry. Finding a buyer for a multi-trillion-dollar exit requires targeting the largest capital pools on Earth. The primary target is the over $600 billion in non-discretionary capital, strictly tracking major indices like the NASDAQ 100. Passive index funds are uniquely vulnerable because they have no discretionary exit. When a company is added to the index, the fund is legally mandated to purchase the stock, regardless of the underlying math. They are now the ultimate blind buyers. To ensure the IPO pipeline captures that demand, index providers initiated a series of regulatory updates. On May 1st, the NASDAQ explicitly implemented rule changes engineered to systematically move these AI entities into the index. Fast entry slashes the index weight from a year to 15 days. Eliminating minimum float accommodates SpaceX listing at 4%. A synthetic multiplier then expands that 4% float into a 12% weight, forcing funds to buy triple the stock. These synchronized changes create a mechanism of systemic forced entry. Safety protocols have been stripped away to ensure that early private insiders have a legally mandated exit buyer waiting for them on the other side of the trade. The massive capital expenditures we are seeing today closely map to historical infrastructure supercycles, specifically the railroad boom of the 1800s and the massive fiber optic build-out of the 1990s. The historical pattern is strict. The physical technology always survives the crash to become the operating foundation for the next generation. But the initial private investors who funded the build-out at peak valuations are systematically wiped out by total bankruptcies. The current AI cycle is facing an external macroeconomic threat capable of popping the earnings bubble before the exit is complete. Escalating geopolitical constraints in the Middle East region are threatening to push global oil inventories to critically low levels. If energy constraints trigger a massive spike in oil prices, foreign nations will require vast amounts of US dollars to purchase the energy they need. To acquire those dollars, foreign governments must rapidly liquidate their largest dollar-denominated assets, US Treasury bonds. This mass dumping of sovereign debt floods the global bond market. With a sudden glut of new supply, bond yields across the world are forced to spike simply to attract buyers. A sudden surge in global bond yields radically increases the cost of capital. The exact corporate borrowing that big tech relies on to sustain the artificial AI sector boom instantly becomes prohibitively expensive. This creates the Warsh factor interest rate dilemma. The Federal Reserve is trapped. Cutting rates into an oil shock accelerates inflation, but holding or raising rates to fight inflation crushes the cheap debt required to keep the circular accounting loop spinning. Rising yields act as structural gravity on tech valuations. As borrowing costs break out, the macroeconomic window for market architects to execute their $4 trillion exit is rapidly closing. Institutional capital is already detecting the exhaustion of this loop, resulting in a severe market anomaly. The S&P 500 recently hit consecutive record highs while operating under negative market breadth. This chart shows the internal divergence. Just 41 AI-related stocks are currently propping up the entire index. That narrow concentration masks the underlying reality that 459 other stocks in the index are actively declining. The broader market is stalling precisely as the global macro environment deteriorates. Navigating this phase requires immediate action. To save the valuations, the American 401k system has been actively weaponized into an automated buyer for a debt-fueled, unprofitable AI bubble. First, you must audit all passive index and 401k exposures. Second, identify exactly which retirement funds are governed by the newly altered fast entry rules. Recognize that historically safe vehicles have had their internal plumbing compromised. You need to know what you are being forced to buy. Survival in this cycle requires abandoning blind passivity. The timeline is accelerating, and capital must be rotated into hardened, probability-based assets before the mandated extraction process begins.